$400,000 in a 401k at age 40. That is better than most Americans. The median retirement balance at 40 is closer to 120,000. So if you are sitting on 3, 4, maybe 500,000, you feel ahead. You probably are ahead. But there is a structural problem hiding inside that portfolio that almost nobody talks about, and it has nothing to do with picking the wrong funds. It has to do with a math shift that happened sometime in the last 3 years, and you did not notice it. Here is what changed. When you were 32 and your balance was $60,000, you were adding maybe $15,000 or $20,000 a year between your contributions and your employer match. That means your new money was roughly 25 to 30% of your total balance every single year. Your fresh contributions were a huge share of the whole pile. That gave you a built-in safety net. If the market dropped 20%, your next year of contributions bought cheap shares and pulled your average cost down fast. That is, dollar cost averaging, doing real work. But now you are 40. Your balance is $400,000. You are still contributing $20,000 a year. That new money is 5% of your total, not 25. 5. Your portfolio stopped behaving like a savings plan. It started behaving like a lump sum investment 3 years ago, and nobody told you. Your portfolio stopped behaving like a savings plan. Why does this matter? Think of it like a boat. When your boat was small, a wave could rock it, but you could bail water fast enough to keep up. Now, the boat is big. A wave the same size hits differently because your bucket did not get any bigger. Your contributions are the bucket. Your balance is the boat. The math flipped, and the old advice that said stay aggressive and keep buying the dip quietly stopped applying the way you think it does. You are earning $200,000 a year. You max out your 401k. Your spouse has a 403b or a similar plan. Between the two accounts, you have built something real. You opened a 529 for the kids. You keep meaning to do something with that cash sitting in the savings account, and every December you look at the allocations for about 4 minutes before clicking confirm on whatever target date fund the plan defaulted you into. That is not laziness. That is a reasonable response to a decade where staying the course kept working. But staying the course and understanding the course are two different things. Let me show you the number that makes this concrete, and then we will get to what most people get wrong about rebalancing at this age. Vanguard published data showing that a portfolio of 90% stocks and 10% bonds, which is what most target date funds hold for someone in their early 40s, experienced a peak to trough decline of negative 43.4% during the 2008 financial crisis. On a $400,000 portfolio, that is a paper loss of $173,000. Now you did not sell. Good. But here is the part nobody models. Your annual contributions of $20,000 only bought back about 11.5% of that loss in the first recovery year. When your balance was $60,000 and you lost 40%, that same $20,000 contribution replaced more than 80% of your loss immediately through cheaper share purchases. At $400,000, it replaced 11%. The recovery depended almost entirely on the market coming back, not on your continued investing. Your contributions became a rounding error in the recovery math. That is the shift. Dollar cost averaging is still real, but its power is inversely proportional to your existing balance. Once your balance exceeds roughly 10 to 15 times your annual contribution, you are functionally a lump sum investor wearing a dollar cost averaging costume. So, what is your number? Divide your balance by your annual contribution right now. In a few minutes, I will walk you through a 3-layer framework that solves this. But first, you need to see why the most common fix people reach for actually makes the problem worse. Now here is where most advice goes wrong, and this is worth hearing carefully. The standard correction people give is simple. Reduce your stock allocation. Move to 70-30 or 60-40. Add more bonds. And that advice is not wrong exactly, but it skips the actual question. The question is not what percentage of stocks should a 40-year-old hold. That framing treats age as a formula. The real question is how much of your invested wealth can you afford to watch drop by 40% without it changing your behavior? Because the risk is not volatility on a screen. The risk is that a big enough drop at the wrong time makes you do something. Because the risk is not volatility on a screen. Sell at the bottom. Stop contributing. Shift everything to cash. Panic is not a character flaw. It is a predictable response to watching 7 years of savings disappear in 5 months. J.P. Morgan's Guide to Retirement found that investors who moved to cash during the 2008 crash and waited until 2012 to reinvest ended up with 47% less wealth at retirement than those who never touched their allocation. The damage was not from the crash. It was from the reaction to the crash. And this is the mechanism that large balance holders are most exposed to, because the dollar amounts are large enough to trigger the reaction. So now you have two problems. Your contributions cannot dig you out, and your reaction can bury you deeper. Take a breath on that one. Picture yourself at 11 p.m., kids finally asleep, staring at your portfolio on a phone screen while the market is down 30%. The crash is not the villain in that moment. Your own hands on the screen are. Now you might be thinking, I held through 2008, or I held through 2020. I would not panic. And you might be right. But Dalbar's annual investor behavior study consistently shows the average equity fund investor underperformed the S&P 500 by roughly 3% per year over 20-year periods, almost entirely from mistimed exits and entries. 3% per year over 20 years on $400,000 is the difference between 1.3 million and 2.1 million at retirement. That is $800,000 lost, not to fees, not to bad funds, but to behavior. That is worth repeating. $800,000. Not from picking the wrong investment, from reacting to the right investment at the wrong time. And the framework I mentioned has a layer built specifically to neutralize that reaction. It is not the layer you would expect. So the fix is not just picking a stock-bond ratio. The fix is building a portfolio you can actually hold through a 40% drawdown without flinching. Because at your balance, flinching is the most expensive thing you can do. That is the lens, not what is optimal, what is holdable. Here is a framework that makes this practical. Think of your portfolio in 3 layers. Layer 1, money you need in the next 3 years. Kids' tuition coming up, a roof replacement, a car. That money does not belong in the market at all. High-yield savings or short-term treasuries. Layer 2, money you will need in years 4 through 10. This is your stability layer. Bonds, bond funds, maybe a conservative allocation fund. This is what keeps you from selling layer 3. Layer 3, everything else. This is your growth engine. This stays in equities because it has a 10-plus year runway, and you will not need to touch it. The insight is that layer 2 exists to protect layer 3 from you. When the next drawdown hits, and it will, you look at layer 2 and say, I have 6 years of planned expenses covered. I do not need to sell a single share of layer 3. That is not a feeling. That is a structure. Fidelity's research on account holders with over $500,000 in assets found that those who maintained a 2 to 3 year cash and bond buffer were 4 times less likely to make allocation changes during market downturns. 4 times. The buffer did not improve returns in calm markets. It prevented catastrophic decisions in bad ones. That handles the structure. Here is what to do with this. First, open your 401k and any brokerage accounts. Add up your total invested balance. Divide it by your annual contributions. If that number is above 10, you are functionally a lump sum investor. Know that. Second, calculate the dollar amount of a 40% drop on your current balance. Not the percentage. The dollar amount. Write it down. If that number makes your stomach tighten, your allocation is too aggressive for your balance, regardless of what any age-based rule says. Third, build layer 2. Figure out what major expenses are coming in the next 3 to 10 years and move that money out of equities. Not because the market will crash, because when it does, you will have already solved the problem before it becomes emotional. This is how the math works. Your numbers are yours to run. Where you live, what your expenses look like, what your timeline is, those details only you know. But the structural principle is the same everywhere. The bigger the boat, the less the bucket helps. Build the structure before the storm, because during the storm, nobody builds anything. They just react. The real question nobody asks after getting the allocation right is this: your 401k has the right mix. Your brokerage is set. But what about the 401k from 2 jobs ago that is still sitting in a default target date fund at an old provider, charging fees you have not looked at in 6 years?